I think we are live. Hello. Hello, everyone. We'll just give everyone a minute to roll in. We have Jesse here with the lovely Mildred.
Hi, good girl.
It's a little surprise guest for us today.
Yeah,
hey, Mildred, how are you?
Sorry.
No worries. It's all I love special guests. So really, we're here to interview Mildred.
She assures me she's a special guest.
Yeah. So, anyways, but thank you all for joining. We'll give it another 30 seconds before we kick it off. Where are you calling in from today, Jesse?
New York. I don't leave.
I love it.
I think I've slept one night out of the city since this started. So New York strong.
Amazing. I mean, it's one thing I'm missing in life. I'm calling out of Toronto, and I used to be in New York every month.
I remember.
Always staying somewhere in Chelsea or somewhere in Williamsburg. So when I can travel again, count me in to. I'll bring Mildred lots of treats as a
go.
A belated thank you. Awesome. Well, we have some people already tuning in, so thank you all for joining us. So I'm super excited to have you, Jesse. For introduction, for anyone who doesn't know myself, my name is Daniel. I'm the host of Founders Live. In the world of Clearbanc, this is our first episode of a new season of interviews we're doing with founders all across the world to tell their stories and share some tactics with all of you. Some history, this is an evolution of a podcast I used to run with my own company before I sold it last year. And so just really excited to feature some amazing stories of folks like Jesse and other guests to come over the coming days and weeks and months. So, a bit about Clearbanc for those who may not be familiar. We are the largest e-commerce investor in the world. We support founders by investing between $10,000 to $10 million in companies through all our form of non-dilutive capital. So if you have any questions about that, head over to clearbanc.com and you can learn more. But we're, not here to talk about that. We're here to talk to you, Jesse. So really great to meet you. And we'll just see how you're doing. What's going on today?
I'm doing great. Monday, I'm on my couch. I got the dog plugging away through the day. All good.
I love it. Well, maybe, we've talked probably every 6 months on something like this. So, I still remember this living room from, I was looking, it was July. We did one of these.
Yeah.
But I imagine there's lots of new people tuning in. And honestly, I love your founder story. So maybe we can just start there to recap for those who, don't know who you are.
Sure.
And your story, where did things start? How did Hubble get off the ground? And then we'll go into it from there.
Cool. Yeah. So I started my career on the investment side. I was at Bridgewater Associates, which is where I met my co-founder, Ben Kogan, and then went to the investment team for Columbia University's endowment for a few years. A lot that was good about endowment investing. You get to look across all asset classes, which is fun, and also a very manageable or predictable schedule. And so took the nights and weekends time that I had during those years and worked with different friends on different startups. Worked with a friend who had a dating app, growing that product in LA. Worked with a friend who was doing, and that kind of pilfered out because we could never get the gender ratio quite right. Worked with a friend who was focused on organ banking, and that was originally a nonprofit and turned into a company called Ossium that I'm on the board of now, that General Catalyst in Vivo backed. So bone marrow, so bone marrow banking, very different from ecom, and that's been cool and fun. And then worked with Ben on Hubble, which was he was at Harry's at the time. He went from interning at Bridgewater to BCG to externship, I guess, at Harry, the Shave subscription. And we started kicking around contact lenses as a subscription category in like late 2015, early 2016. Raised first money in May 2016, launched in November 2016, and I've had the business live for 4.5 years now. So have done that, have started other businesses in e-commerce, have advised a ton of businesses in e-commerce. So oddly find myself in the position of just spending all day thinking about digital ads and what you can sell with them, which is exactly what I want to be when I grow up. So it's been a lot of fun.
I love it. And so, I mean, there's so many places we can jump into, and I love whenever we do this, it's like, yeah, here's the start to the current day of Hubble. But I'm always very fascinated about that early days of, your first pitch of Hubble, and as you write about in your book, and as we've talked about, the funding environment is very different today than it was back then. But I think it's still worth repeating, how that started. Of you came up with this idea of there's something here in the contact lens business. What was that conversation like with Ben and then your first?
Yeah, sure. So honestly, I always talk about the book. The book's called Selling Naked, by the way, available on Amazon and major booksellers. Got to do my service to my publisher at Random House. You need both. Well, you can either bootstrap a business, or if you're going to fundraise for a business, it's important. Everybody focuses on product market fit, and that's the most important at the end of the day. If you're not solving a problem for a customer, whether that's a consumer or a business customer or whatever it may be, there's not a reason for the business to exist. But if you are going to seek financing, and 2016, when we launched Hubble, there was still a lot of equity capital going into box subscription startups. It's important that you have investor market fit as well. And you'd be surprised the number of businesses that die because of investor market fit. And that doesn't mean, it's funny, there's a lot of variations on this. There's one like, oh, the VC or the investors are evil because they don't understand my vision. Well, no, their job is they have a fund, and they have to deploy that money into a certain kind of assets for their investors. And that's, I've sat on the other side as at an endowment. Like, you want your VCs investing in VC businesses, and you want your real estate funds buying real estate, and yada yada yada. And so they have a job to do, and they have to make sure that it fits a mandate. And then they also have to look out at what multiples are in that space. And not to oversimplify the venture job, but those are kind of the two primary filters: is does this fit the mandate of the type of business that my investors want to see me investing in? And then is this a space where multiples are high? Because it's you can build a great business in a space where multiples aren't high, but it's a lot, but high multiple. I mean, you've been there. High multiples give you a lot more room for cushion. And so if VCs aren't excited about your business, that doesn't mean that you don't have product market fit, or that there's something, or the potential for product market fit, or that there's something that they're missing. But it does mean that it's not a good fit for VC, probably, and that you should hear that feedback and think about whether you want to move on to another idea, bootstrap that business, whatever you may want to do with it.
I think one thing that I always love talking to you about is different ways to think about financing the business, and that kind of ties more to present day, where Hubble's raised over $75 million of capital over the lifetime of the business. Great supporters through FirstMark, who supported
FirstMark Founders Fund, Greycroft, Colgate Palmolive. Yep, we've gone to work with great investors and have really enjoyed them and our board. I think you definitely have to think about all the ways you can finance it. So just laying out some options on the table. There's sort of traditional venture equity, whether that's coming from a fund or angels, but it's coming in the structure of a price round or a convertible note or a SAFE, and that's sort of the first place people's minds go. There are non-dilutive capital providers. So we've already talked a little bit about Clearbanc, but there's Clearbanc and other folks who are looking to finance against the business. Those are generally not going to be literally day zero dollars, because whether it's financing against marketing spend, or financing against inventory, or financing against some other KPI for the business does need to have KPIs. And so then you're talking about who else can finance. And I think the two partners that are underestimated are your supplier and your customer. And if you think about, crowdfunding is kind of the extreme of customer funds your business. And I think people have this weird idea. You see a lot of folks who will do a crowdfund raise to, I think, prove demand for the product, but then we'll sort of abandon that as a financing strategy. And the truth is, working capital is working capital. If you're really filling a gap in the market and customers are having trouble finding competitive offerings at similar pricing, then they might be willing to advance you pretty meaningful working capital, and you might be able to not just do crowdfunding, but pre-order. And as long as you have to be very set accurate expectations about when you're going to fulfill that product. And you might get meaningful, not, financing from your customer in the form of a rolling pre-order roll. And so that's one option. And then the other is suppliers. And I think supplier as financing partner gets to sort of to me, the heart of what makes a good direct to consumer business, which is, okay, there's some businesses, I like, I talk a bunch with John Fiorentino, who started Gravity Blanket and Moonpod and Birth Date Candles. And he's really good at coming up with or identifying early a genuinely new consumer category, kind of a bit ahead of the curve, and riding that sort of wave. And that's not something I know how to do at all. And and I don't think that's something that most direct founders are in the business of. It's an unusual skill, and it's whatever. It's some combination of creativity and intuition and being really plugged into different social streams. A lot of direct businesses you're some kind of value player. It's generally not like the true value player, because like there's just not, you do need to cover Facebook marketing costs, you do need to cover shipping. And if you're going to do discount toothpaste only costs a couple bucks a tube, so discount toothpaste isn't going to leave you with much margin to play with. But you see a lot of these Bombas, sort of premium socks for a little bit less. Who's the Figs, the Scrubs folks, premium Scrubs for a little bit less.
Yeah.
And you go after the premium end of Hubble was dailies, which is the premium product in the contact lens market for a bit less. And you try to do a value offering on the premium product, but you do need good underlying COGS there. And I think this is, I've talked to so many businesses that think they can just market it better. And I think this underestimates how rational the consumer is. Consumers out there on Facebook, they're looking at lots of businesses, hitting them with lots of offers, or Instagram, or whatever the platform is. And consumers pretty good at evaluating this stuff and really deserves a lot of respect. And there's so many founders who say like, oh, if I just tweak the landing page just so, or I change, like, look, the site's got to work. You need the right ad creative, but also like the Facebook ad library now. So the playing field's been massively leveled there, because everybody can see what creative's performing for everyone else. By the way, you should check out the Facebook ad library regularly if you're not already. And so like, if the playing field for creative is pretty level, if the bar for sites is only so high and it'll convert fine, then really we're just talking about like, what are you offering the consumer that they can't get elsewhere? And that's and at some point, like, if you don't have competitive COGS and you don't have competitive margin structure on your product, it's going to be very hard, because somehow, like, generally, whatever, we can villainize the incumbent in whatever category you're playing in, but generally people are accepting normal wholesaler margins, and those can be healthy, but it's not like
it's not the same. It's not the same. I mean, if I can interrupt you here, because I think
go for it.
What I would love to understand or share with the audience is you did something very, very tactical and strategic, and I always give you credit, but I love repeating this idea to other folks, is as how you actually negotiated a deal with your supplier. Where and I'll let you explain it in more in depth, but the way I always frame it is, you've essentially created this competitive advantage by trading some portion of equity to expand your margin to give you a long-term competitive advantage. And so to reframe exactly what you're saying is, what are you giving to the consumer that they can't get anywhere else? You're giving them cheaper contact lenses because you've sold to the supplier this equity stake to say, hey, you're going to benefit in the long run, so give me a better deal today.
And this actually wasn't something we were able to secure on Hubble, but it is on some other businesses we've been involved in, and it's transformative for the business. And this, and that's exactly where I was driving with this, which is, okay, you're gonna have great product and you're gonna have competitive pricing on it. that means you need a scaled provider. You need somebody with good underlying COGS, and you're not going to have that capacity day zero. So really, a lot of the value is coming from your supplier. But the good thing is there's lots of suppliers out there who don't have direct commerce as a distribution channel. So your perspective, you're starting a brand, you're starting a business. Let's say that I have a board member on a swim brand called Andy. Let's say that you're a large swim importer. From that swim importer's perspective, who has all the buying scale and swim construction capabilities, buying scale with the factories and in-house swim construction capabilities. Direct commerce is just a distribution channel they're missing. They have for different quality products at different price points. They have their Walmart, they have their Walmart channel, they have their Target channel, they have their I guess it's less of a thing now, but they're Blooming Nordstrom's department store channel. They have their Amazon channel, and they're missing their whatever Facebook, Shopify, whatever you want to call it, channel. But the challenge is you can't just shove your existing product into that. You need to use your supplier capabilities, your product development capabilities, your scale, your buying scale with manufacturing, or if you do the manufacturing yourself, your manufacturing capacity, but you need to you need it bundled up in the way that Instagram wants to see. And so the way that Harry's went about vertical integration, which was to buy the factory, but that's really crazy. You have a large, take that example, you have a large razor manufacturer, and most of their business isn't going to be Harry's, at least for a long time. I think today it probably is, but at the time they did this deal, and so now it's sort of the dog ate the fire engine. You're left with this startup that has to manage a private a wholesale business, the legacy wholesale business they probably don't have much knowledge of or interest in. Whereas if you reverse integrate and you convince the supplier that they should take equity in you, now you have access to all their capabilities. They get to continue to profitably operate their other business lines, and they get a hedge and exposure to this other distribution channel that they're currently lacking.
Yeah.
Now, the thing that they have to trade away is, instead of taking their comp in cash, they have to take it in equity. But if they're a reasonably scaled supplier, it's probably worth it to get that get the diversification in their product distribution portfolio.
And so this is a question that came through earlier. It was more about, it came through when we were talking just about general investing, but I think it applies, specifically to this of, can you walk me through in however specific you can be of how that conversation went? How did you identify the supplier? What was the specific pitch? What did you write in that email, or what was that first phone call like for any business that, you've successfully brokered a deal like this?
I think it's just research. It's going through and doing your sort of consultancy homework and building out a market landscape, because it's not just, there's not going to be that many suppliers available in any given category, because if it were, then they wouldn't be the scaled good one. And so really the hard piece is building out that market landscape, especially because a scaled unbranded supplier is going to be doing a lot of private label. And so figuring out who's doing a lot of the product for a Walmart, who's doing a lot of product for an Amazon, who's actually making the stuff. And then it's sort of whatever, spit and gumshoe and hustle and getting on LinkedIn and guessing at email addresses. And hopefully you hunt down the right people, and either they'll be interested or not. But that's kind of what the daisy chain looks like. It's more gumption than anything else.
No, I think that makes a lot of sense. I mean, I wanted to jump to another question. We have something here from Gary, which I think, if by pre-order, I assume that means around pre-sales, because that's when it came through. But this is the other half of what we were talking about. So we talked about supplier financing.
Sure.
Can you, how would you generally walk through how should you think about doing pre-sales, whether that's through an Indiegogo or through,
I think you just do it through your site. We've done this on multiple businesses, and you have to disclose very clearly, because otherwise it's how you want to treat your customer. B, it's a customer service nightmare. But you say not available right now, pre-order for X to X, 1 to 2 months or whatever it is. And all of a sudden your customers are advancing you 6 weeks of cash. And as and as you're scaling a business, that can be very, very valuable.
Yeah. Yeah, well, there's another company I saw, one of our founders that we know very well called Vessi, and I thought they did an interesting take on this where it was they're in flight, so they obviously have product and cash flow, but they started selling reservations for new products. So they had built up this behavior of like, our stuff always sells out, so pay $5 today to lock in.
Yeah, but we've had with launched businesses, and you have this, it becomes a real pain point. Demand is healthy. We can't, we're backlogged on, we're out of stock on orders, and it's just how big a swing do you want to take on, how much working capital do you have available, and how big a swing do you want to take? And if your customers are willing to make their demands clear by putting down money, by placing that order and de-risk the POs that you're placing, the purchase orders that you're placing, that's really valuable.
Yeah. Yeah. Well, so this is another question. I'm surprised I never asked you this before, or maybe I have, but something that worked really well in our, when Ray and I ran a subscription beauty box business, it's almost 10 years ago now when we started that, we financed the business off of annual subscription. So we sold a full year subscription.
That's the same thing. Selling ahead.
Yeah.
Yep.
So for something like Hubble, though, it's so I've been subscribing to Hubble since whenever I met you. I'm wearing Hubbles right now, so Thank you for helping me see you and see the world. And I also haven't checked the site since because it just shows up, which is a proving.
Yeah, we're I think I know where you're going with this. So we're monthly subscription, but that's part of it. Is what pain point are you solving in your category? So so the standard thing with contact lenses is you're going to be pushed no matter what channel you're going to buy in relatively large quantities. And tying up that, for a lot of consumers, tying up that much cash in inventory can be uncomfortable. And so there we're solving, it's just who needs to finance who. If you're bootstrapped and you're cash tight, but you're providing good value to your customer, maybe they'll finance you to get the deals, especially if the product, if having product in hand isn't so urgent for them. And then if you have the cash to do so, maybe you can help finance your customer, and maybe that's a value to them. So I think that's the thing, is who's financing who, and who's feeling the tighter liquidity, and how do you maximize the value of the merchant customer relationship based on those pain points.
This is another question from Sebastian that falls on right of this is how do you balance in a pre-sale scenario the cash outlay for inventory without saying, oh, it's going to be 6 months before you actually ever get a product. How have you thought through that when you've done these before?
Sure. I think it's the variable that's most neglected when starting one of these things is minimum order quantity. And I think it just is, like, I thought about, honestly, pre-order more in the context of a live business than starting a business. More just back order, honestly. I think I was just talking about this with Shane over, at Clearbanc the other day, which is I think it's worth trading off. I would always take meaningfully worse economics on an initial order to get. It's important to know where your costs are going with a little bit of buying scale. To get those mature those mature product costs day zero and have to take a big minimum order to get it really isn't worth it. And I'd always take bad pricing terms on a smaller order to get the ball rolling.
Yeah. Yep. No, that makes sense. I'd love to jump to the other side of it. So we've been talking about the financing side. We've been talking about supply chain, inventory, and managing all that. The other part, which I love nerding about with you, is on the marketing side. It's both of our dreams when we grew up, is to spend time on this. Maybe we can start something a bit more kind of contemporary. Being, I think last time we talked, I was looking through what we spoke about, and there was let's focus on Facebook and Instagram as the #1 channel to scale, and then we slowly, incrementally move on. I'm curious how your view of that has changed, if at all. Where there's a lot of noise today in the market about what's happening with iOS 14, what's happening with cookies, and should founders care about that at all?
I think this is so overhyped, and maybe this will be a disaster for us. So I think it's not been the best few months as a Facebook advertiser, and I think that's been true across a lot of teams I've talked to, and I, I'm skeptical though. I'm skeptical though that the iOS 14 thing is such a big deal because you think about it, at the end of the day, Facebook is an auction, and it's just the same thing with Google and cookies. Like your biggest concern as an advertiser should be the number of impressions Facebook and Google have available and Instagram have available, and how quickly that inventory of that impression inventory is going. At some point, if their ability to target disappears entirely, and they're just like truly flying randomly and blind, and contact lenses are a product for women 25 to 45. If we're delivering our impressions to 85-year-old men because they're truly flying with no insight, then that's a problem. But like on the margins, which would I rather take? Which would concern me more? What's been happening, which is that the impression count is growing meaningfully slower, or that on the margin they lose a little bit of their targeting capability. I think the targeting edge can degrade meaningfully and not matter that much. I think slower impression growth is a big problem for advertisers because that's what we live off of. And as long as Facebook can and Instagram can as long as Facebook can allocate the impressions well enough, if my targeting is less precise, but your targeting is less precise, then we're at a comparable disadvantage in the auction. So it's not like either of us is really worse off. And again, there's some falling off point where the auction has degraded materially and is no longer functional. But I don't get any indication that that's kind of the cliff we're approaching. And so I'm skeptical. I think on the margin, and this is what happened with CCPA, it probably favors more resource direct response advertisers who can implement workarounds and work with, have rep teams. I think I'm so used to as a digital direct response advertiser being the minnow up against the Facebook and Google whales. But I think in this case, we're still the minnow, but we're at least a slightly bigger minnow. And if you have the rep relation, and it's a little unfair in that if you have the rep relationships, if you have more dev hours, you're getting feedback from those organizations on how to manage as well as possible through these changes. And the teams that have the resources and the feedback to do that better than worse on the margin should be benefited in the auction, because again, the impressions have to go to somebody.
Yeah, no, that makes sense. So we have another question here. It says, thank you all for dropping questions in the comments. Please keep them coming. So it's a question again from Sebastian on the way I would really summarize this is thinking about your budget and how to scale and test. And
so I'll tell you. Okay, this was one of the more fun things I got to work on in 2020. Was I did some work with Andrew Yane's nonprofit around Facebook fundraising for COVID relief and then for voter registration. And both of those, COVID relief, they had a fundraising drive going already. Voter registration, they didn't have any. But in either case, they have a Facebook initiative going. And so I said, let's just start with $25 and see what happens. And we spent $25 and that worked. And so then we spent $50 of that. I think growth marketing professionals, whether that's a consultant or a full-time hire or an agency or whatever, don't because they don't want to get an engagement and lose it after 5 minutes. Don't like to say that you should have data very quickly on whether something's going to work. It doesn't mean you have to invest meaningfully behind an account to get it to scale, because the volume of creative and landing pages and everything else goes up the more you want to spend. But if you're trying to spend very little, if there's any traction there at all, it should work okay generally. But this is where it gets awkward against the minimum order quantity thing, because I think the real thing that happens is okay, I shell out $20K to buy inventory of something. Do I really want to give up after $50 that I'm not going to be able to sell it at all? So I think that's how this really gets sized, is if I blew $20K in inventory, I should be willing to at least lose $5,000 trying to conclude that I can't move product on something. I think that's more the logic flow.
Yeah. And so I'd love to kind of fast forward though to, let's assume you figured out demand and there is product market fit and you are scaling and hopefully you're selling out in your own back order and need to figure that out. I really like the concept that you talk about on this idea of a marginal CPA and using that as your indicator for knowing when to scale. And lots of the founders that I talk to, may not have the financial background or the comfort of like, how do I calculate that? How do I build it? Like in the simplest terms, what is that? And what would that dashboard look like for me?
We're back to calculus 101 and derivative finally get useful. No. Everybody knows to care about their CPA. Everybody knows to care about their, that return on ad spend. But the concept that people neglect is, okay, if my LTV off of, let's keep this simple. Let's say my LTV off a customer is $100. And let's say I just get no time discounting, because obviously $100 today is worth more than $100 a year from now. Let's just say I get it all up front, so I don't have to discount any cash flows backwards. I should be willing to pay up to $100 for a customer. And so then founders will say, oh, cool, my CPA target is 100. But that's not right, because it's not. What's weird is you don't know what your CPA target is at all. What you have to do is test around in the platform and say, okay, today I'm going to spend $500 more than yesterday. Tomorrow I'm going to spend $500 more than that. The next day I'm going to spend $2,000 less than that, and see, as I shuffle around budgets, how many more customers am I actually getting? That not just if I'm spending $10,000 today versus $11,000 tomorrow, not just what's my CPA, but how many extra customers am I getting for each extra $1,000 I'm spending? What's that incremental? Because that incremental, you should be willing to pay up to $100 in this example for that incremental customer. But it could be like the curves can be very steep on this or very shallow. It could be that your CPA, your average CPA is 80 and your incremental customer is 100, or it could be that your average CPA is 30 and your incremental customer is 100, because you're able to scoop up a bunch of customers at 20 and then the curve runs away from you and you really can't spend that much more beyond what you can get for a $20 CPA. And so there's no good way I know of to figure it out other than to futz around with budgets and see where the numbers shake out. But that's really the core concept that you're going after. That's the magic number you want to know, is how much can I spend so that last dollar that I'm deploying, I'm breaking even on, and I'm profitable on all the dollars before that.
Mm-hmm. And really to build on that from what we've talked about in the past, it's really once you're starting to see the maxing out of this marginal CPA, that's when you start looking at testing new channels and adding to it.
Sure. If you have good ideas on new channels, please hit me up. I think for worse or better, we became smarter marketers, and our ROAS increased and all the rest when we started accepting that there's not that many channels that work, and that life's tough. Life's tough. We don't all get to be astronauts, and there's a reason why a couple companies are just continuing to hoover up market share in the ad space. That doesn't mean it's always good to test around. You can find that we deploy into other channels. It's just smaller, but like if you were to call it duopoly and other, maybe we get other to like 10 to 20%, which is worth the squeeze. But I think I've seen more founders waste a lot of money going down the somewhat quixotic pursuit of really diversifying their marketing budget than I have founders really find scale or improve their ROAS by diversifying.
Yeah. Yeah, well, I think this is something we can talk about ad nauseum, and I'd love to jump to. We kind of jumped over the Hubble story and the personal story behind it. But one thing I wanted to make sure I spoke about was, in the book, I was trying to post a link. Hopefully, it went live. If not, look up "Selling Naked" on Amazon. You'll find it there, or you'll find it on Penguin Random House, and I'll point you to some other places to buy it. You talk towards the end of the book about the stresses of when you launch a company. You have to be, mindful of just burnout and things like that. But I imagine a lot of people that are going to be watching this have already launched their company and are facing new kind of stresses. And so I'm curious for you, are there any moments over the past 6 months, the past year, past 4 years, once the company is scaled, what have been some of the other difficult things you've had to manage within Hubble? And I would love to just kind of hear how you work with those things.
I felt good today. Marginal Revolution had a post up, I'm sure it's still there, saying that some economist did a study of CEOs and said that it lowers your life expectancy by a statistically significant margin, and whatever, it makes me feel less lonely. Whatever, it's the violin nobody wants to hear play. It's but like it's just like it's there's days where it feels really good when everything's working, and then and then most of the time it isn't that day. And I think, and I don't think that really, at least for me, that hasn't really changed. It's just you get more used to the fact that that's the job, or I've tried to get more used to the fact that that's the job, which doesn't change it entirely, but makes it a bit more manageable on the margins.
Is there an example of a new kind of stressful moment or challenge you've run into recently that's something like net new? Because I mean, I've had that experience with Exact before, and every founder's lived through like, hey, I thought.
Oh, sure. I mean, we were never the company that had tight supply chains, and now like every e-commerce company, all sorts of supply chain pinch points because of COVID are capacity limits at our manufacturer, who doesn't have access to all the labor that they're normally working with, delays on ocean shipping, all these USPS delays, concerns which haven't happened to us of what happens if warehouse workers get COVID and that kind of thing. And so like all of these, this business that had been always managed very conservatively on the inventory side is kind of this substantially capitalized venture-backed thing. Like we're managing through it fine, but it's definitely it's something, it's something new that hadn't caused us headaches in the past that we get to work through now.
And inevitably, part of that too is a lot of the stress, a lot of the work comes in working with other people. Whether that, your suppliers, naturally, you've always worked through virtually for the most part, but with your own team, that's obviously changed over the past little while. And I'm curious if there's anything you've learned over the past 12 months on, as a leader running a company like yours, what are ways to help communicate with your team and manage their own stresses and concerns when you can't hang out in a room together or grab drinks together as easy as you could?
Yeah, I think the hardest thing is, I mean, it's there's a lot of positives in it, and it's a lot of what employees have been encouraged to look for and expect from their jobs, but people just have a lot of expectations about what role their employment will serve in their life, and it's hard to you as a business at the end of the day have a job. Your job is for the consumer. You have to collect and fill orders. That's what your job is, and it's hard to manage that, and sort of manage what other expectations team members and employees might be bringing to their professional life. And like, look, I totally get it, and I'm sympathetic, because like I was a kid of the 90s, I was a child of the 90s too, and like I was loaded up with all those expectations as well. But that's a lot to, but that's a tricky one to manage.
Yeah. No, I can imagine. I mean, I love, as we're kind of coming towards the edge of our time in the next couple of minutes. I'm just curious, what else are you excited about? You have you always have different projects on the go. I think last time we talked about the window company you were working on. This is in July. We talked about what you're doing with Andrew Yang. What are exciting projects or initiatives or ideas you're
sure has been a good stretch for Mockingbird, the stroller company I'm advising. Let's see, I'm advisor to a customer service business, Resolve CX. That's been going well. What else do we have going on? We're launching glasses soon, so that'll be fun.
Oh, very interesting.
Very, what else?
This is through Hubble or a separate brand through Hubble?
Yep, through Hubble. Have been doing some digital advising for the mayor's race, so that's been fun. And yeah, always just kicking the tires on new projects that hopefully have to announce in the next few months.
I'm still waiting for my January coat for next season.
we had Harper. We had rebranded Harper. We had a good season at Harper. That was fun because we got the unit economics to work this season, and we're clearing a profit on each coat net of marketing, which is always the gold standard that you're looking for with the e-commerce business. So yeah, it's been all the usual headaches, but it's been a fun stretch.
Well, actually, let's. I mean, we're going to jump back into Hubble, which was not my intention with this question, but I'm curious. You're launching glasses. Like, what was the discussion like in the company of why now? Why did you decide to do this?
It's been in the queue for a while. It's just these things just take long. It always takes longer to get things live than you think you will. We'll be going small at start, just testing into a new category, and we'll figure it out from there.
Yeah, because I can imagine just the SKU complex. I mean, I guess you still have a SKU complexity with contacts, given all the different.
Yeah, you have to hold you have to hold a few frames, but I mean, a lot of it's lab work on the lenses then, so it's not it's not like you're holding all of those.
Yeah, that makes sense. I mean, in terms of I guess on a personal life side, when we can travel again and live our full lives, is there anything you're particularly excited about?
Yeah, I'm excited for you to be hosting dinners again.
Very soon. For now, we just do them over Zoom and we have these little live chats. But we'll be back, back on the Lower East Side soon to host our dinners in New York.
There we go. That's all I'm waiting for.
That's awesome. Well, as I told you, it's this is a new experiment for us running these founder lives. So I just wanted to say thank you so much for being our inaugural guest of the new season.
Thanks for having me.
Yeah, and so for everyone else watching, thank you for the comments and questions. The recording will stay live if you guys want to check back into it later. Tomorrow we have Jenny Bird and my co-founder from my last company, Elena, who's now joined Jenny to run as COO, Jenny Bird, which is an amazing jewelry company.
Nice.
So that's tomorrow. And then Wednesday we have Catherine Homuth, who runs a company called SheerTex. Indestructible pantyhose business, and they just are doing really, really great. So encourage you guys to check that out. Jesse, thank you again. Everyone is asking where your lovely dog is. I'm sure she's there. You are. Hey, here you go.
Hey, look at that. She's a star.
I love it. Anyway,
yeah,
so
all right.
thank you so much.
You're welcome.
Yeah, see you later.
Have a good one.